Welcome to the Real Estate Forum, a podcast from the Paul Milstein Center for Real Estate at Columbia Business School. I'm your host, Raphael Sidelsky. This is your place for key insights into the evolving real estate landscape, from candid conversations with real estate thought leaders, including the esteemed faculty of the MBA Real Estate program, to cutting-edge research from the Milstein Center's Research Lab. Let's dive in. My guest on this episode is Adam Gallistel, co-CEO and CIO of CBRE Investment Management. Adam is responsible for investment strategy and performance globally, along with investor engagement. Before joining CBRE Investment Management earlier this year, Adam spent a decade at Singapore's sovereign wealth fund, GIC, where he served as head of America's real estate and head of global real estate credit. He was a member of GIC's Real Estate Global Investment Committee, overseeing billions in investments around the globe across equity and debt in private and public markets. Adam was known for positioning the GIC portfolio towards next-generation growth sectors like data centers and other assets that sit at the intersection of real estate and infrastructure. He expanded the private debt and equity businesses through controlled deals, joint ventures, and strategic platform investments. He is a graduate of the University of Pennsylvania and Columbia Business School. Adam, welcome to the Real Estate Forum podcast.
Thanks, Raphael, and thank you for the kind introduction. I'm excited to be here today.
Adam, you led GIC's real estate platform in the Americas and helped shape its global investment strategy for over a decade. What did that experience teach you about deploying long-term sovereign capital across cycles and across the capital structure?
The markets can be humbling, right? So I guess probably four things that I learned over the years that aren't necessarily generic to real estate. One is we should always approach the market with humility. I think arrogance can be our undoing investing almost all the time. I think the second thing is to prepare, not to predict. Actually, my former CEO used to say that all the time. And I think we live in a world of probabilities, and sort of preparing for potential outcomes as opposed to being certain about what might happen next probably positions you best for investing. I think third is really just a value investor philosophy, which, frankly, Mark Twain characterized best when he says history doesn't repeat itself, but it sure does rhyme. And then finally, I think flexibility and the ability to pivot are just crucial to long-term investment success. As they say in the military, as the facts on the ground change, so must our view. And, you see it across all kinds of industry. If you have a hammer and draw the same nails all the time, sometimes that leads to suboptimal outcomes. So the ability to pivot and have systematic frameworks to analyze the market so you can see where the puck is going. This gives you the ability to act in what Warren Buffett would say is to be greedy when others are fearful.
You were responsible for both private equity and credit investments globally. How did you approach risk and return when you had the ability to play everywhere along that spectrum?
Oh, yeah, sure. So picking up on the point I just made about systematically, systematically analyzing the markets is you need to make some sort of order out of chaos. And so I think it's important for any investor, CBRE Investment Management, GIC, to really systematically occupy the occupier markets, so traditional supply and demand, but then realize that the occupier markets don't necessarily move in sync with the capital markets. And even within the capital markets, the markets can be out of sync. So what's going on in the private equity markets can be different than what's going on in the credit markets, can be different what's going on in the public markets. I think the important thing is taking those four, public, private, credit, occupier markets, and looking at them systematically and analyzing them systematically allows you to spot points at where those markets are out of sync with one another. And those market inefficiencies are the best points at which to lean in. But you can only do so to the extent that you've organized yourself to understand what's different.
Well, that's an excellent framework, and we're going to talk more about that later in the episode. Now at CBRE Investment Management, you're leading one of the world's largest real estate investment platform. What drew you to the role, and what do you see as the most exciting opportunity for CBRE IM today?
So I would break that into two broad categories. First is culture, and then the second is edge. Right? On the culture side, listen, almost to a person, every person I've met at CBRE Investment Management have just been genuinely good human beings. In some ways, it's an extension of the CBRE ethos, where, if you think about our overall platform, it's one of the largest commercial real estate, or it is the largest commercial real estate and infrastructure services provider in the world. Against that backdrop, it means we have engineers, we have people on the front lines doing property management. And so the ethos of the firm is a service ethos, is deeply rooted in the man on the street, as opposed to a lot of finances oriented sort of the barbarians at the gate mentality. And for me, I embrace a everyman culture, a culture that where essentially a no jerks policy. So the first thing for me that was a real draw is that just everything on the cultural front I really liked about CBRE and CBRE Investment Management. Say the second thing is edge, right? Is I believe there's sort of four differentiating things that are going to give you edge in real estate today. One is scale, right? So as everybody knows, there's a fair amount of consolidation going on in the industry. And scale gives you two advantages. One, it clearly gives you a capital raising advantage. And two, it gives you the advantage to play where the air is thin. And so when you get into the larger transaction of the world, the number of players that are able to compete in that space is fewer. And generally speaking, I find that less competition leads to better outcome for investors. I think the second edge I would talk about is information. CBRE and CBRE Investment Management are uniquely positioned to have an information advantage. As a subsidiary of the world's largest service provider of real assets, essentially we have access to data and information that puts us inside the matrix, allows us to see where the puck is going, slows things down, and gives us a real ability to act before others see the same thing. I think the third thing is operating expertise. Increasingly, one of the things that really attracted me about CBRE is that we have dirty fingernails real estate people who can drive NOI. I think the days of relying on cap rate compression to make your returns appear to be over. I know we all hope they come back, but let's assume they're not. And so actually the ability to drive NOI at the operating level without multiple layers of fees was one of the additional things that attracted me to CBRE. And then finally, the last point, Raphael, that you mentioned was, digital and infrastructure more broadly. And one of the things I really like about CBRE Investment Management and CBRE is that we're no longer just a real estate company, we're a real assets company. And I think the lines between infrastructure and real estate are blurring. And those who have the ability to actually play on both sides of the fence there are likely to have superior outcomes to those who are relegated to just one or the other. So let me pause there.
Well, absolutely. And we're going to touch on some of that in more detail. Before we do, just want to talk about your global mindset. You've invested from Americas to Europe to Asia. CBRE has a similar mandate. What do you see as the common threads of value creation in real estate versus what is truly market specific?
I just touched on them in that information advantages, operating edges are the things that are really going to drive out performance. If a couple things, again, they go back to sort of value investor principles. I think the first thing you have to be very cognizant of and be very afraid of is anytime you hear the four most dangerous words in finance, you should hold on to your wallet. Those four words are "this time is different," right? Is that I can't tell you how many times I've heard that in my career. And invariably, I go back to my earlier point that, history doesn't repeat itself, but it rhymes. I think the second thing that's universal around the world is that leverage is always the catalyst that forces a reckoning. And, people will pretend and extend until they can't anymore. And usually it's when capital has to be injected into the system because of some sort of debt maturity, that usually triggers some of the most interesting value opportunities and also is the trigger point across markets where things change from the old to the new.
You touched on the fact that CBRE IM invests across real assets. The boundaries have been evolving in terms of what's real estate, what's infrastructure. And, you've got things like data centers, renewables, powered land. How do you see those boundaries moving and how are you positioning yourself to take advantage of the most attractive elements within that broad framework you have to invest?
So within I think if you're just addressing the digital infrastructure space, we address that mostly through our infrastructure business. I know people are always like, is it on the real estate? Is it on the infrastructure side? The beauty of our organization is we don't care because we operate it as a unified format, but the people actually executing come out of our infrastructure group by and large. Generally speaking, within infra, I'd say we have a barbell approach. We are currently most largely invested in operating companies where you have the benefit of both some combination of development expertise as well as network dense telco hotels, retail colo. We actually think that's one of the best businesses, if not the best business in the data center space, because it's one of the few businesses that we know in real estate and infrastructure writ large that has a true moat, in that the network effects that come from having Google connected to Amazon, connected to CBRE, connected to everybody, that spaghetti of interconnections is really hard to replicate and has enormously high switching costs. And therefore, there's a ton of value when you have a real moat. On the other side of the side, the hyperscale space, which is the space that everybody talks about today, candidly, we are approaching it with cautious optimism. I think we start with the knowledge that with $1 trillion going into the ground, its history would suggest that there are not good investment outcomes for all $1 trillion. And so we want to be very disciplined and play where we extend the absolute minimum amount capital possible before we have lease in hand and power in hand. To the extent that we actually find ourselves advancing quite a lot of capital, both against the land as well as the securement of power, in advance of having secured any leases, frankly, that pattern of fact starts to rhyme very much like what happened in life sciences, where we like to say the difference between the two in life sciences and data centers today is that you're not going spec on data centers. But the reality is, from an equity at risk perspective, where land values have gotten to and where power costs have gotten to before you need to actually have a lease, most of the equity you're going to put at risk goes into those two pieces. Because once you have the credit, the lease is eminently financeable. So we're hyper focused on managing that upfront CapEx spend so that we don't get left holding the bag. I'd say across the rest of the complex, putting aside digital infrastructure, and actually even within digital infrastructure, we also, as some of our competitors like to say, they're the picks and shovels to the AI industry. I sort of joke that we are the rivets for the picks and shovels, and that we're playing in and around the battery ecosystem, the transmission ecosystem, the generation of power to those data centers. We think those businesses, frankly, we can engage in without taking a ton of development risk and are critical in order for the picks and shovels to drive so that they can ultimately drive AI. Moving away from digital into the larger, let's just say US universe for now, I'd say some of our top conviction themes are strip retail and unanchored strip retail. Office curious, I wouldn't say it's a high conviction, but we think it's tactically time to start playing in office again. And then, at the risk of sounding like all I do is talk my own book, there's probably two sectors that we're currently not active in that I think are interesting, which I continue to think net lease and parts of the credit spectrum are interesting, even though we're not active there. I put out a word salad for you, so let me just stop there and see if you have any follow-up questions.
Well, no, that's great, because the next segue was into the US market. We're in this period where you've got higher interest rates, slow transaction market, and selective capital flows. And I wanted to touch on where you see the opportunities. And so you started talking about it. Maybe now that you've touched on it, tell us a little bit more about the segments. You said retail, office curious. What are your thoughts on industrial and housing, alternatives versus traditional? How do you see your asset mix and geography sort of playing out in the US over the next few years?
So I go back to those earlier frameworks of talking about capital markets as distinct from occupier markets, right? And actually, we're looking at the intersection where you're not paying too much for actually pretty good fundamentals. Frankly, that's what drove both CBRE and my former employer into a lot of the alternative sectors in the past. in that they traded at higher cap rates relative to traditional real estate. They had good, strong demand tailwinds, and they had capex intensity that by and large tended to be less than traditional sectors. So if you added those three things together, plus financing that was basically at parity with traditional real estate sectors, you had more free cash flow or dividends going into your pocket. And dividends to me are one of the best way to de-risk the potential cone of investment outcomes, because we can all put in forecasts about what cap rates may be, but the reality is we don't know. So taking that same thought process and applying it to the pattern of facts today leads you to actually different places, in that there's been a big run in alternatives. Everybody is now desperate to get into them. And there's been a rotation away from a lot of the traditional sectors. One of the most interesting ones is strip retail, where actually, because of the retail apocalypse, investors haven't been in the space for a long time. Two, actually, over the last 20 years, some interesting things have happened. One, there's basically been no new supply of strip retail. Two is the tenants in retail have rebased their approach so that they understand an omni-channel world. And so now we've had both through COVID and 20 years of internet, people the chance for retailers to test their business models and adapt to the new world. So you're not taking that known unknown risk about whether or not these retailers can survive. Putting this together, no new supply, more resilient customers, and frankly also the combination of grocers having consolidated in the space, which actually makes the grocer quite much healthier too, is you have this interesting combination today where you actually have very strong demand, some of the best releasing spreads we've seen, nearing record high occupancies and no supply on the forefront. So you actually get a supply demand equation from the occupier markets that looks super compelling. You layer onto that the fact that most investors still remain a little gun shy of retail. That leads to actually cap rates being higher than they are in many of the other sort of beds and said sectors. That has two benefits. One, you're buying higher yield, but two, and equally as important in my mind, is you're buying at yields that are accretive to your financing cost. And I think we all have learned both now and through the global financial crisis, no matter how good the assets are, it's a very hard way to make a living when you're climbing out from underneath a mountain of debt that makes it very hard to invest in your assets. So retail is one of those areas where we have very high convictions today. I say I go to office second, office curious. Listen, I'm on record on podcasts like this in the past, and I will still say that I don't love U.S. office as a business. It's the opposite of everything I was just talking about. It's Russian roulette on the leasing. It's oversupplied. It's massively capex intensive. But because everybody hates it right now, or almost everybody hates it right now, we think you have a unique opportunity where office now is priced as it should be, which is off of free cash flow, whereas historically it's been priced off of NOI. So we're actually seeing selective opportunities where you can price based on what real free cash flow is and make good returns because, the proverbial baby has been thrown out with the bathwater. I think that's a point in time. I don't think it persists forever, but it's actually a very interesting time to be selectively layering in some office into your portfolio. The other two sectors, I'm not going to really spend much time on, which was net lease and data center and credit. And that's largely because I don't have either of those businesses there. That may change in the future, but I don't want to really do too big an advertisement for some of my potential competitors.
Fair enough. Let's pivot to Europe. In a recent research piece, you argued that Europe is looking increasingly attractive relative to the US for core real estate investors. And you referred to 4 pillars of value: replacement cost, discount to prior peak, fund flows, and cap rate spreads to risk-free rates. Why does Europe screen so well right now in those areas?
I think ultimately it comes back to fund flows. Why Europe screens well is that over the last 24 months, there's been about 4.5 times as much money raised for a US real estate as continental European real estate. And so that means you just have and notwithstanding that, the market's only about 70% bigger. So you have a lot more people chasing the same opportunities in the US, whereas in Europe, you have a lot fewer, a much shallower pool of capital chasing on relative terms. Essentially, I'm misspeaking here, but let me just put it in with a punchline. The punchline is that you're a bigger fish in a smaller pond in Europe than you are here in the US. And generally speaking, from a value investor perspective, that's a good place to be. I'd say the second thing is that, America is the land of plenty and we love to get things done. And that's a double-edged sword. That's led to a lot of dynamism in the United States. Our decreased regulatory framework has led to a lot of new construction. The double-edged sword of all that dynamism is now in many sectors, we are fundamentally oversupplied. And in many markets, we are fundamentally oversupplied, which leads to weak forward outlook for rental growth. On the flip side, Europe is sort of benefiting from its historical inefficiency in that there just wasn't a lot built in Europe over the last cycle. And so as demand slows, there's just not a lot of overhang to absorb. So bigger fish in a smaller pond, better operating fundamentals, and headline pricing that looks cheaper in relative terms in Europe than the US. I would call that a trifecta that makes on margin it interesting to lean into Europe. Now, listen, the reality is the US is the world's largest, most liquid, sophisticated market in the world. I'm not saying run for the hills on US. I guess my message is let's just stop ignoring Europe. It actually has pretty interesting opportunities.
Any thoughts on US LPs who've been hesitant to invest abroad in terms of currency risk and the timing of things today, vis-a-vis currency?
Especially with Europe, you actually get paid to go into Europe. But this is because of the differential in the yield curves. If you want to hedge back, you're picking up roughly 100 basis points of carry. And, for those who are purely dollar-based investors, that's an added incentive to me to actually be going into Europe today.
Got it. Switching back to data centers just briefly, you talked about the areas within the digital world that you're interested in. There's still, in every aspect, a ton of capital chasing that space, and you have both credit and obsolescence risk. How do you think about those things and pricing in the sector today? Even if you have an example, you pointed out your confluence of a co-location facility with great multiple credits. How do you know that facility and the chips that are in there, the Blackwells or whatever, are going to be around in 3-5 years and as valuable to the occupiers?
First thing is location. So if you're in, say, Ashburn, Virginia, I think regardless of what goes on in technology, you're likely to have an interesting and viable space because it's the confluence of basically every data center in the world, and it's got dark fiber, dark power, and good access to power, right? And I think those sort of the real estate 101, location. To me, I spend most of my time thinking about, do we have locations that help buffer us against ultimate concerns and residual value? Say the second thing is actually on this obsolescence point. I think this point's overblown by many in that if you're providing a powered shell and that powered shell has the ability to adapt to provide additional water cooling and heat cooling and water and air cooling, to me, that's actually your best insulation against obsolescence risk. Right. Generally speaking, we don't own the racks inside, the computers inside. That stuff gets changed out all the time. But at the end of the day, no matter how dense things get, you just need, generally speaking, as they get denser and they take up less square footprint, they actually produce a greater heat footprint. And so on net, you still kind of need the same amount of space. And so really, to me, the question around obsolescence is, am I able to economically retrofit my buildings to supply tomorrow's cooling and power needs? If that is there, I worry less about the degradation and functional obsolescence of everything else. And frankly, this has been tested. We've looked at some of our portfolios where data centers were built in the 90s, and we said, hey, if we wanted to bring this up to today's heat and cooling standards, what's the incremental CapEx investment we'd have to make? And in many cases, we're finding it's like 10 to 20%. And so that's actually sort of normal wear and tear if you think about any other commercial real estate business we're in. The other thing is on the functional obsolescence is people sort of talk about, oh, hey, is there some known unknown chip, be it quantum computing or what else, that's going to make it so that we just don't need all these data centers altogether? I'd make an analogy. So think of all the efficiency gains that come from increased compute power, increased efficiency, less need for space, as some version of Moore's Law. And now think of Moore's Law as essentially a drain at the bathtub at the bottom of the ocean. Each incremental increase in efficiency leads that drain to get bigger. But what people ignore is on the countervailing force is that each efficiency gain has historically led to step functions in our marginal propensity to consume data. So while you do have that drain getting bigger and bigger, each time the drain gets bigger, it unleashes a biblical flood of additional data to be consumed, right? I mean, all you have to do is look at stats which say, and I'll get the direction right, but the actual stat wrong, that something like 100% of the previous amount of the world's data has been stored again in the last 2 years, right? And so that the propensity, be it AI, Internet of Things, driverless cars, what have you, the propensity and need to consume data, in my mind, only goes up as chips get more efficient, which ultimately you got to plug all that data into the ground. It's got to be stored somewhere. And data centers are going to be part of that critical ecosystem for a long time to come.
Adam, one of your strengths has been, and you talked about this, navigating across the capital structure. With liquidity still tight generally in real estate, where do you see value now between public and private markets? A lot of the REITs are trading at discounts to NAV. Do you believe those NAVs? And how do you think about public versus private right now on the equity side?
I think across the globe right now, valuations are more compelling from a buyer perspective in the public markets than they are in the private markets. Even if you adjust for the discounts that the public markets tend to trade on what notional NAV is, the public markets look relatively cheap. And so again, portfolio construction is not about going all in on one thing, but on a relative positioning tilt, I would be encouraging people to increase their tilt to the public markets at present, with respect to both infrastructure and global real estate.
You spend a lot of time with investors around the world. What are the themes you're hearing most from them? And how are you convincing them to invest in real estate when there has been this big demand for private equity, private credit, and those sectors have outperformed real estate for the last several years?
It's tough, candidly, right? I mean, I'm pleased to say, and going back to some of the edges that investment management has, is we're on track to raise $12+ billion this year, right? So even in a constrained capital environment, I believe, are capturing more than our fair share of the available wallet out there. We can't lead, you can only lead a horse, you can't to water, you can't make them drink. So we can't convince a investor whose CIO has told them they're not doing real estate full stop to put money into us. What we can do is say, offer a better solution for people is existing real estate allocations. And again, when I go back to that edge of having the information advantage through our adjacency to CBRE and through our scale, coupled with our operating expertise, that's where been the winning move that's allowed us to raise that capital. I look at our Asia business, where we have a small vertically integrated industrial developer in Japan and Korea. That has been a very successful story, and that has resonated with investors. And so our ability to deliver something differentiated in the marketplace is the way we can attract capital.
And where do you think the biggest capital flows will come into US real estate from in the next several years? Is that, institutional sovereigns? Is that the US high net worth market?
I think we have to start to embrace a reality where institutional allocations to real estate writ large, not to say there won't be individual plans here and there that increase their allocations, but I think we're in for a period where, unlike the last 30 years, where allocations are either flat to slightly declining. And that's a function of what you just talked about. From a CIO's perspective, they're looking at their alternatives pie. They've already transitioned to something that looks like an endowment model. They're now looking at, hey, how much real estate do I want versus credit versus infrastructure? And right now, in most CIO offices, it's an easier argument to allocate to the others than it is to real estate. And so I think we just need to be cognizant of that reality, that the tailwind of the last 30 years of just massive increasing fund flows from institutional investors into real estate is likely to be flat going forward. Where I do see real potential for huge inflows is as you said, in high net worth or retail capital writ large, is if you think about a traditional endowment model, anywhere from 25 to 50% of your assets are in alternatives if you're an institutional investor. Today, in retail capital, nearly 100% of the capital lies in public markets. And so, as we, as service providers, figure out how to adequately service and provide investment excellence for retail investors, I think there's likely to be large capital inflows from the retail community into alternatives writ large, including real estate, as they transition portfolio construction to something that looks more like an institutional portfolio. Frankly, it doesn't even need to go to a 60-40 publics alternatives mix. Even if penetration goes from 1 to 7%, that's billions and billions of dollars of net inflows for which we have a sacred trust to manage responsibly on the behalf of, our mothers, doctors, lawyers, et cetera, and so on.
So how are you positioning the firm to be, one of the providers of capital for those seeking the next generation of real estate allocations, real asset allocations that outperform and then compete effectively with other forms of alternative allocations?
We in general are in the walk before you run category, doing it through partnerships where we partner with either long only mutual fund managers, or we do a sub advisor with an insurance account, where we're creating tailored hybrid products that offer a portion of real assets liquidity sleeve, anywhere from 30 to 50%. That would be a combination of infrastructure and real estate, and a private sleeve. And we think actually that's a better mousetrap than just privates only, because the liquidity helps solve sleeve where it's stocks going in and out. It helps manage sort of near-term both inflows and outflows, and provides a product that allows more flexibility for both the manager and the ultimate customer in terms of how they manage their portfolios. When you have a illiquids only portfolio, you run into very similar circumstances as to what we just went through, where the gates go down, and that's what the gates are supposed to do. But retail investors, when they want their money back, they want their money back. And so having something that actually combines liquidity with an option to harvest the illiquidity premium, we think is a better mousetrap going forward.
Adam, you're a really thoughtful investor who often has a contrarian view or thinks about things that others don't. What keeps you up at night? What is your biggest concern in the real estate space right now, and what's your biggest cause for optimism?
I'm a nerdy Jew living in New York City, so everything keeps me up at night. Like I get paid to worry. If I had to reduce it to one thing, I do continue to worry about stagflation. Stagflation is generally an environment where almost all equity assets don't do particularly well. And so that's, if I had to reduce it to one, that would be it. I also spend hours worrying and making sure that we continue to have the right to win. And so that means making sure that we've got the right people on the field in the right positions, and make sure that we're putting out the A team there every day. So I'd say stagflation on the outside, making sure we have the people and processes in place to win on the inside. Optimism for the future. Look, I don't think you can be in the business of investing unless you're fundamentally kind of an optimist. Because the business of investing is that ultimately you're going to put $1 in the ground today and it's going to be worth more in the future. And that is there's no greater expression of optimism unless you're a short seller. But then I guess you're just optimism and your convictions, than the willingness to put your money to work in the hopes that it'll be worth more. So when I look around the world, I take a step back from all the news headlines. I take a step back from the day-to-day morass that's going on the reckoning that we had from when money was free. And I say, listen, we're at a unique point in human history where actually by objective measures, morbidity, infant mortality, aggregate wealth, education, we're actually at one of the best points in human history known to man. And that ultimately speaks to we're always moving forward. We always had progress. And I think it also gives me a North Star to see beyond the day-to-day, hey, XYZ is yelling at PDQ and say, no, listen, notwithstanding the news cycle, we are getting better as a populace. The economies are getting better. They just go through cycles. And if we can remember that this too shall pass, that onto itself is a source of optimism for me.
What about career advice? Do you have any advice for professionals who really want to excel in the investment management space?
Yeah, so probably have a couple of pieces of advice. I have three North Stars, which I think are critical for any good investor. One is curiosity. You have to have the curiosity to ask the unknowns. Two is accountability. If you're not willing to stand behind and own both your rewards and your failures, and own everything and that comes with you, I find, generally speaking, you're not going to have success. And then the third thing is rigor. Is if you think about all the things that I was talking about in the past, is ideas are frankly manifold and everywhere. It's the ability to act and execute on ideas that differentiates people. And the only way you can do that is if you've rigorously approached the markets and understand them so that you can move and be greedy when others are fearful. I'd say the other sort of more personal investment advice away from necessarily investing is, in general, there are plenty of people who can report the news. There are plenty of, actually, let me qualify it, have an informed point of view. There are plenty of people who have points of views without facts. I find the people who differentiate themselves are those who can synthesize the news into a unique point of view and substantiate that with facts. And so I think any young professional, if they can do that combination of having a differentiated point of view and synthesis of the and back it up with facts, they're going to go far in their careers.
That's great advice. Curiosity, accountability, rigor, and an informed point of view. Switching on to a more sort of personal front, I'd like to ask you if there is a book, a habit, a mode of exercise, a philosophy, something that's been meaningful to you that you would share with us.
There's this entrepreneur and author named Jesse Itzler who talks about this thing called the Misogi Challenge. And just by background, Jesse Itzler is he organizes a series of endurance challenge, among other things, but he endurance challenges that are meant to test your mental and physical mettle. The Misogi Challenge is actually based on a traditional Japanese Shinto purification ritual, but Itzler sort of morphed it into his own thing. And really, it's a mental and physical test designed to expand your sense of what's possible. And so I love this idea of a Misogi challenge, right? The idea is that you set out to do at least one thing a year that is really hard. And the goal is to push your limits. Ideally, you should have a 50-50 chance of success or failure. And because in that, you're forcing to train and consistently confront potential failure. Two, I like staring into the abyss. You must be a little bit scared. I like being comfortable in the uncomfortable spots. When it rattles your nerves, it keeps you sharp. It makes it's existential. It makes you better. Three, you got to pick something that you're not doing for your parents or your friends or for the adulation of others. It's got to be something deeply personal that you're doing for yourself. And I think so in my particular case, I in some ways I view my step into CBRE as my own CBRE investment management as my own Misogi challenge. And the immediately before that, along with Roy Marsh, had done what's called Everesting, where you hike the vertical equivalent of Everest under a time trail in less than 36 hours. And the idea is that by completing and doing something one extremely difficult event each year, you create a reference point for yourself of strength and resilience that positively impacts you for the remaining 364 days of the year. I think that's just a very cool thing that we should all embrace and incorporate into our lives.
Absolutely. Wow, that Misogi challenge is a unique one, and taking on something every year that you may fail at, but has nothing to do with, like you said, your parents or your friends or necessary career advancement sounds like a great idea. So thank you so much for that. Thank you so much for joining us on the Real Estate Forum. We look forward to seeing how you and CBRE Investment Management navigate this new global real asset cycle and shape the next generation of real assets investments worldwide.
Thanks, Raphael. I really appreciate you having me on the show. And shout out to my Columbia alums. Love Columbia Business School.
Thank you for listening to the Real Estate Forum, a podcast brought to you by the Paul Milstein Center for Real Estate at Columbia Business School. Be sure to subscribe for more insights from real estate thought leaders, industry professionals, faculty, and the latest research and expertise from the Milstein Center's Research Lab at Columbia Business School. If you've enjoyed the episode, please follow, rate, and share the podcast. You can keep up to date with the Paul Milstein Center for Real Estate at business.columbia.edu/real estate. Thanks again for joining us, and we will see you next time.